Presently, while most people are distracted, while the world's commotion intensifies, something silent, powerful, and transformative is developing beneath the exterior of the global financial infrastructure. And if you overlook this instance, history won't duplicate it for you. It will simply advance without you. $10,000 silver isn't a fictional headline, it's a warning indicator. An indicator for those who are alert. An indicator for those willing to reason differently, act differently, and construct a future instead of wishing for one. I want you to pause and listen attentively because this isn't about panic. This is about preparation. It's not about fear. It's about clarity. Every substantial shift in prosperity has materialized quietly, long before the masses realized what was occurring. By the time everyone concurs, the opportunity has already vanished. There was a period when gold was seized, currencies crumbled, and empires collapsed. Not because people were malicious, but because people trusted systems that were already fractured. Robert Kiyosaki has cautioned repeatedly that artificial currency creates artificial security, and artificial security creates genuine poverty. Most people labor more intensely every year, yet feel more impoverished every month. That's not coincidental. That's a design defect in the system. Consider this. You can labor your entire existence, accumulate numbers on a screen, and still conclude with nothing when inflation silently deteriorates your buying power. That's why history's wealthiest investors didn't pursue paper guarantees. They accumulated tangible assets, assets you can't print, assets you can't fabricate, assets that survive chaos. Silver has always been the currency of the people. Gold is maintained by central banks. Silver is maintained by those who comprehend cycles. And presently, silver is being consumed, not merely stored. It's utilized in technology, energy, medicine, and the infrastructure of the future. Every solar panel, every electric vehicle, every advanced circuit silently extracts silver from the earth and never returns it. Supply contracts while demand erupts. That's not exaggeration. That's mathematics. Here's the mentality shift most people overlook. Wealth doesn't reward effort alone. It rewards positioning. You don't need to forecast the future flawlessly. You need to stand in the correct location when the tide shifts. The investors who altered their lineages didn't await confirmation. They awaited conviction. Examine history's greatest wealth constructors. They didn't purchase assets when everyone felt comfortable. They purchased when the headlines broadcast fear and confusion. They comprehended that volatility isn't danger. It's opportunity wearing a disguise. While others panic, they prepare. While others consume, they accumulate. And this applies far beyond currency. In existence, development always demands discomfort. The instant you cease pursuing approval and begin pursuing comprehension, your world expands. You begin perceiving how patience defeats speed, how consistency defeats intensity, and how composed reasoning defeats emotional reaction. Silver instructs this principle perfectly. It doesn't shift loudly initially. It shifts slowly, then suddenly, just like genuine achievement. Question yourself honestly. Are you constructing something tangible or merely renting comfort? Are you trading your time for paper or converting effort into assets? Every paycheck is a determination. Every expense is a vote. Every delay is a cost you may never recover. There's a reason people like Kiyosaki emphasize financial education over financial prediction. When you comprehend currency, you cease fearing crashes. You begin preparing for them. You diversify, not because you're frightened, but because you're disciplined. You don't pursue prices. You construct positions. You don't wager everything. You accumulate intelligently. This is where begin reasoning like an owner, not a consumer. Decrease dependence on debt that depletes you. Construct cash flow where possible. Convert excess income into assets that protect buying power. Learn the distinction between price and worth. And most importantly, cease awaiting permission to secure your future. The greatest tragedy isn't failure, it's regret. It's recognizing too late that the indicators were evident, the warnings were loud, and the opportunity was genuine, but comfort maintained you immobile. You don't need to be prosperous to reason like the prosperous. You need courage, patience, and education. Imagine reflecting years ahead, understanding you acted while others hesitated, understanding you didn't panic, you prepared, understanding that while the system shifted, you stood on solid ground. That confidence doesn't originate from fortune. It originates from intentional choices made early, quietly, consistently. This is larger than silver. This is about reclaiming command over your existence, about stepping out of the herd and into awareness, about recognizing that genuine security doesn't originate from promises. It originates from ownership, knowledge, and discipline. $10,000 silver isn't hype, not a fictional headline designed to astonish, and not a guarantee of instant riches. It's a signal, a quiet warning that the monetary system most people trust without questioning is fracturing beneath the surface. Throughout history, currency has always transformed its form when confidence vanishes. Empires didn't collapse overnight. They deteriorated gradually while citizens continued daily existence, unaware that the principles were shifting. The indicators were always present: excessive debt, endless currency generation, contracting buying power, and an expanding gap between effort and compensation. Today, Those identical signals are flashing again, louder than ever, yet disguised as normality. When governments print currency faster than worth is generated, they dilute the labor, time, and savings of ordinary people. Inflation isn't accidental. It's a concealed tax paid by those who maintain paper guarantees excessively long. This is why silver matters, not because of price targets, but because of what it represents. Silver is tangible, concrete, limited, and historically recognized as currency across civilizations. It cannot be generated with keystrokes. It requires energy, labor, and time to extract. That alone separates it from fiat currencies constructed on trust rather than substance. What makes this instance different is that silver is no longer merely currency. It's a critical resource. Modern technology consumes silver permanently. Solar energy, electronics, medical equipment, and advanced infrastructure all depend on it. Unlike gold, much of this silver is never recovered. Supply contracts quietly while demand expands relentlessly, generating pressure that doesn't announce itself until it's too late for the unprepared. Markets don't shift when everyone comprehends the narrative. They shift when reality collides with denial. Intelligent investors don't await headlines to transform positive. They listen for signals beneath the commotion. When respected voices warn about currency degradation and systemic risk, they're not forecasting dates. They're highlighting patterns. Wealth shifts don't reward speed. They reward awareness. Silver's potential climb reflects not greed, but a loss of confidence in paper systems that guarantee stability while delivering erosion. This is why silver at extreme valuations isn't about speculation. It's about survival of buying power. Those who comprehend this don't pursue price. They accumulate protection. They perceive silver not as a trade, but as insurance against financial instability, a bridge between the previous system and whatever substitutes it. While most people concentrate on numbers on a screen, the quiet transfer of worth continues underneath, reshaping futures, redefining security, and separating those who prepared early from those who trusted excessively long. If this message resonated with you, if it challenged how you reason about currency, existence, and the future, then remain connected. Engage with this content, subscribe to the channel, and share it with someone who needs to hear it before it's too late. Because the subsequent chapter of prosperity won't be announced loudly, but those who are listening now will be ready when it materializes. Genuine prosperity has never been constructed by awaiting permission or confirmation from the masses. It has always been generated by those willing to stand isolated before the result becomes evident. Positioning early isn't about guessing flawlessly. It's about recognizing sequences before they're accepted as truth. By the time an opportunity feels safe, it's typically expensive, crowded, and stripped of its greatest capability. The majority awaits certainty, not recognizing that certainty only manifests after the compensation has already been claimed by those who acted with conviction. History makes this painfully evident. The most substantial fortunes weren't constructed at the peak when headlines were optimistic and confidence was elevated, but during periods of confusion, skepticism, and disbelief. When new technologies emerged, when markets collapsed, when systems were questioned, early movers quietly accumulated while others hesitated. They didn't possess superior information. They possessed superior perspective. They comprehended that markets are driven not merely by numbers, but by human psychology. Fear delays behavior, and comfort destroys opportunity. Positioning early requires emotional discipline. It means tolerating doubt while others mock, criticize, or disregard what you're executing. It means acting without applause. Most people are trained to seek validation before making determinations, especially financial ones. They desire reassurance from experts, companions, or media before committing. But validation always materializes late. By the time the masses concur, risk has already transformed into compensation, and entry becomes expensive. This principle applies far beyond investing. In existence, careers, and personal development, those who advance first shape the landscape. Entrepreneurs who awaited perfect circumstances never constructed anything lasting. Individuals who awaited until confidence materialized never departed their comfort zones. Confidence isn't a prerequisite for behavior, it's a result of it. Early positioning compels development, clarity, and resilience because it demands responsibility for results rather than excuses. Intelligent positioning isn't reckless. It's calculated patience combined with research, learning, and awareness. It's comprehending macro patterns instead of pursuing short-term excitement. It's constructing exposure gradually while time executes the heavy labor. Early movers don't commit everything emotionally. They remain grounded, adaptable, and informed. They understand that time rewards those who align with long-term forces rather than daily commotion. The masses react to price. Disciplined investors react to worth. The masses question, is it safe now? While early movers question, does this make sense over the subsequent decade? This distinction in reasoning separates participation from leadership. Prosperity follows leadership. Those who position early aren't fortunate. They're simply willing to act before comfort materializes, before certainty forms. before the narrative becomes popular, while opportunity still murmurs instead of broadcasts. Paper currency provides the appearance of stability while quietly losing its substance, generating a sense of security that feels tangible until it suddenly isn't. Numbers on a screen appear permanent, but their worth depends entirely on trust. Trust in governments, trust in policy, trust that tomorrow will resemble yesterday. History demonstrates that this trust has always been temporary. Every fiat currency ever generated has followed the identical route: introduction, expansion, overuse, and eventual decline. The progression is slow enough to feel normal, which is why most people never notice the hazard until buying power has already been drained. The illusion functions because paper currency is convenient. It enables people to store effort digitally, transact instantly, and plan for the future without contemplating what actually supports their savings. But convenience frequently conceals expense. When currencies are generated without restraint, they dilute existing worth. Each new unit makes previous units worth slightly less. This erosion doesn't materialize as a sudden collapse. It materializes quietly through higher prices, contracting buying power, and the sensation of laboring harder just to remain still. Tangible assets function differently. They don't depend on policy determinations or political guarantees. Their worth originates from scarcity, utility, and human demand. Land cannot be printed. Metals cannot be fabricated from nothing. Energy, labor, and time are required to generate them. That inherent expense generates a natural flow of worth that paper systems lack. And when uncertainty elevates, capital flows toward what is concrete because concreteness restores confidence. This is why tangible assets have survived every monetary reset in history. When currencies failed, ownership didn't. Those who maintained assets weren't exempt from volatility, but they retained optionality. They could trade, rebuild, and adapt. Those who maintained only guarantees had to initiate over. The distinction wasn't intelligence, it was structure. One side stored worth in systems, the other stored worth in reality. Modern financial education seldom emphasizes this distinction. People are instructed how to earn currency, not how to preserve it. They're trained to accumulate numbers, not to question what those numbers represent. Over time, this generates dependence on institutions rather than comprehension. When strain enters the system, dependence becomes vulnerability. Tangible assets don't eliminate risk, they transform it. Instead of depending on trust, you depend on fundamentals. Instead of hoping policies remain favorable, you align with physical constraints that cannot be negotiated away. The shift in reasoning transforms conduct. Spending becomes intentional. Accumulation becomes strategic. Prosperity ceases being about accumulation of currency, begins becoming about protection of buying power, stability across cycles, and independence from systems designed to benefit those closest to the source of currency generation. Silver occupies a rare position in the world of assets because it exists simultaneously as currency and as an essential industrial resource. And this dual role generates pressure that most people underestimate. For thousands of years, silver functioned as a medium of exchange, a store of worth trusted across cultures and borders. Long before modern banking systems existed, silver carried buying power because it was scarce, divisible, and universally accepted. That monetary history never vanished. It was simply pushed into the background as paper systems dominated. What has transformed is silver's role in the modern economy. Unlike many traditional assets, silver isn't sitting idle in vaults awaiting sentiment to shift. It's being consumed daily. Advanced electronics, renewable energy systems, medical technologies, and industrial manufacturing all depend on silver's unique conductive and antibacterial properties. No other metal presents the identical combination of efficiency and reliability at scale. Once silver is utilized in these applications, much of it is lost forever, dispersed in ways that make recovery uneconomical. This generates a structural imbalance. Mining supply expands slowly, constrained by geology, regulation, and expense. New discoveries require years, sometimes decades, to develop into production. Simultaneously, industrial demand continues to expand as technology becomes more silver-intensive. Green energy initiatives alone require massive amounts of silver for solar panels and electrical infrastructure. As the world electrifies, silver consumption accelerates, not retreats. Unlike gold, which is primarily stored and recycled, silver is depleted. Above-ground inventories contract quietly, while attention remains concentrated elsewhere. Markets frequently misprice assets when their importance is misunderstood. Silver's price has historically been suppressed by its classification as an industrial metal rather than a monetary one. Yet its monetary characteristics never vanished. When investment demand returns, it competes with industrial demand for the identical limited supply. This convergence is powerful. When confidence in financial systems deteriorates, people seek concrete stores of worth. When technological development accelerates, industries require more physical resources. Silver sits at the intersection of these two forces. Few assets confront pressure from both sides simultaneously. This is why small shifts in demand can lead to outsized movements in price. Comprehending this dynamic transforms perspective. Silver isn't merely a speculative wager on markets, it's exposure to a fundamental imbalance. It represents participation in technological advancement while maintaining a hedge against monetary instability. Those who recognize silver's dual nature perceive beyond short-term charts and concentrate on long-term scarcity, tangible utility, and the quiet tension constructing between finite supply and expanding global demand. The greatest investors in history were never comfortable when they made their most significant determinations. They acted during instances of uncertainty, when information felt incomplete and emotions dominated the market. Confusion generates hesitation, and hesitation generates opportunity for those who comprehend how cycles function. When fear elevates, prices disconnect from worth, and assets are presented at discounts that only exist for those willing to reason independently. Comfort, conversely, signals that opportunity has already passed because comfort only manifests after risk has been eliminated and compensation has been decreased. Market panic is seldom rational. It's driven by headlines, narratives, and collective emotion rather than fundamentals. During these periods, people liquidate not because the asset has lost its long-term worth, but because they desire relief from uncertainty. This emotional liquidation transfers assets from impatient hands to patient ones. Every substantial wealth transfer has followed this sequence. The assets didn't vanish. Ownership simply transformed. Accumulation during chaos requires a different relationship with fear. Instead of avoiding it, accomplished investors study it. They recognize that fear compresses time horizons, compelling people to concentrate on the subsequent headline instead of the subsequent decade. By extending their time horizon, disciplined investors gain an advantage. They pose different questions. Not what will occur tomorrow, but what is likely to matter years ahead. This shift alone filters out most commotion. The capability to accumulate when others panic originates from preparation. It's constructed long before the crisis materializes. It requires liquidity, education, and emotional governance. Those who enter chaos without preparation become victims of volatility. Those who prepare beforehand become beneficiaries of it. This preparation isn't about forecasting collapses. It's about assuming they will occur and structuring determinations accordingly. This mentality extends beyond financial markets. In enterprise and existence, instances of disruption generate openings for those willing to advance while others freeze. New leaders emerge when previous systems fail. New ideas gain traction when previous assumptions collapse. The identical principle applies. Confusion clears space for advancement. Purchasing during panic isn't about bravado or recklessness. It's about recognizing that markets overshoot in both trajectories. Just as euphoria inflates prices beyond reason, fear pushes them below reality. Those who comprehend this dynamic don't celebrate chaos, but they don't fear it either. They remain grounded in fundamentals, directed by discipline rather than emotion, accumulating worth quietly while the masses seek safety, understanding that when comfort returns, the window of opportunity will already be closing. Financial freedom commences with a shift in identity, not income. The distinction between those who construct lasting prosperity and those who remain trapped in cycles of earning and spending isn't how much they generate, but how they reason about ownership. Consumer reasoning is reactive. It concentrates on convenience, status, and short-term satisfaction. Owner reasoning is intentional. It concentrates on command, leverage, and long-term resilience. This mentality transformation quietly alters every determination that follows. Consumers question how much something costs. Owners question what it generates. Consumers trade time for currency and then trade currency for comfort. Owners trade effort for assets that continue functioning long after the effort is complete. One approach generates dependence, the other generates optionality. Over time, this distinction compounds into freedom or frustration. Modern systems are designed to encourage consumption. Advertising fuels desire. Easy credit eliminates friction, and social pressure normalizes debt. None of this is accidental. A consuming population is predictable and controllable. Ownership, however, introduces independence. When you possess productive assets, you're less dependent on constant income, less vulnerable to disruptions, and less influenced by fear-based determinations. Owner reasoning also transforms how risk is perceived. Consumers avoid risk because loss feels personal and immediate. Owners manage risk because loss is comprehended as part of development. They diversify, insure, and structure determinations to survive errors. They don't eliminate risk, they distribute it. This enables them to act when opportunities manifest rather than freezing in uncertainty. This mentality extends beyond currency. In careers, consumer thinkers await to be selected, promoted, or approved. Owner thinkers construct abilities, networks, and leverage that generate options regardless of external validation. They invest in learning even when there's no immediate compensation. They comprehend that command over results originates from preparation, not permission. Shifting from consumer to owner doesn't require prosperity. It requires awareness. It initiates with questioning habits, comprehending cash flow, and prioritizing assets over liabilities. Small determinations made consistently generate structural transformation. Over time, ownership compounds, not merely financially, but psychologically. Confidence expands from understanding that advancement is being constructed beneath the surface. Financial freedom isn't about escaping labor. It's about selecting labor. It's the capability to decline poor opportunities and accept meaningful ones. Owner reasoning constructs this capacity quietly, step by step, substituting dependence with discipline, impulse with intention, and short-term comfort with long-term command over time, energy, and trajectory. Volatility is frequently portrayed as danger, but for those who comprehend how systems conduct themselves under strain, it becomes a source of opportunity rather than fear. Price swings, market shocks, and sudden uncertainty don't generate risk independently. They disclose it. Volatility exposes weak structures, over-leveraged positions, and emotional decision-making. For the educated and prepared, this exposure is valuable because it generates clarity where comfort once concealed reality. Most people are conditioned to fear movement. They associate stability with safety and transformation with threat. Yet, stability in distorted systems is frequently an illusion maintained by constant intervention. When that intervention deteriorates, volatility manifests. This instance feels chaotic to the unprepared, but it's simply the system expressing its genuine state. Those who comprehend this don't panic when prices shift. They analyze why they're shifting. Education transforms volatility from commotion into information. Instead of reacting emotionally, disciplined individuals seek signals. They study liquidity, fundamentals, and long-term patterns. They recognize that rapid price transformations frequently reflect short-term fear rather than long-term worth. This enables them to advance when others retreat, not impulsively, but deliberately. Preparation is what separates opportunity from disaster. Volatility punishes those who are overextended, underinformed, or dependent on perfect circumstances. It rewards those with adaptability, patience, and margin of safety. Possessing reserves, avoiding excessive leverage, and comprehending one's own risk tolerance generates the freedom to act when others cannot. In this way, preparation transforms uncertainty into advantage. This principle applies far beyond markets. In existence and enterprise, periods of disruption accelerate transformation. Abilities that were optional become essential. Inefficiencies are exposed. New leaders emerge because they can adapt, while others grasp outdated models. Those who invest in learning before disruption materializes navigate volatility with confidence rather than confusion. Volatility also compels honesty. It eliminates illusions about competence, strategy, and resilience. When circumstances are straightforward, errors are concealed. When circumstances contract, reality asserts itself. Those who embrace this feedback expand stronger. They refine strategies, strengthen foundations, and construct systems that can withstand strain. For the prepared mind, volatility isn't an adversary to be avoided, but an instructor to be studied. It sharpens judgment, rewards discipline, and generates entry points that only exist when fear dominates. Those who comprehend this don't seek chaos, but they're ready for it, standing steady while others retreat, utilizing movement as momentum rather than resistance, and transforming uncertainty into a catalyst for long-term advancement and strength.